Welcome everybody to the Build Your Legacy webinar series with Andy McMullen and our special guest, Adam Stern. Very excited to talk to you guys and have a banter and discussion about this exploding trend that we call build to rent. It's going to be very fascinating for those of you guys that are seeing this as an opportunity for people to move away from value add multifamily and or other commercial real estate asset classes and find and discover these new opportunities and plays for creating generational wealth. Adam, why don't we start with a little bit of background on you, my friend? Very
Sure.
funny. We actually produced and created some content around inviting people to the event, and then we sent the wrong picture of this other Adam Stern. So this is funny. I want to own up to this. But
he was a lot better looking than me. So I don't think it was an accident. I think it was totally intentional. You're not forgiven.
Adam, who are you? How did you get into this space, my friend?
Yeah, so I'll try to condense it into a 1-minute story. I started a real estate, an online real estate platform called Own America with a partner of mine. Original thesis, which was my partners at the time, to give him credit, was to train real estate agents on how to work with investors, because real estate agents didn't generally know how to work with investors. So we created this online training program. Where I was the guy that went door to door selling the training program to brokerages, and we created this big network of trained agents with our certification. And then Blackstone and Invitation Homes and American Homes for Rent started raising money on Wall Street to buy foreclosures and then turn them into rental properties. And we thought they're buying their real estate on the MLS in part through real estate brokers, and they should be using our real estate brokers. So we turned our network into an acquisition service for some of the original REITs. And then throughout that process, I kept running into people with portfolios. And I realized there was no dedicated, targeted brokerage service to help people with portfolios sell their portfolios in one transaction. So Own America became that, a brokerage to sell single family rental portfolios. And we sold that business in 2018 to a company called Renters Warehouse. And I ended up being able to leave in 2020. And I brought all my buyers along with me, save for a select few. And they were all asking me for this new thing called Build for Rent. They were saying, hey, Adam, can you go out there and start finding us Build for Rent projects? And I didn't really know a whole lot about new construction or building or general contracting, but I figured it was real estate. Can't be that hard. As long as you have the buyers will tell you where to go look for the assets. So I started Strata in 2020. And after a couple of years now, we've done 14, going on 15 build for rent projects that we put together, a few dozen portfolio sales, and we're kind of just doing our thing. We're doing the whole brokerage in build for rent projects and brokerage in the scatter site single family realm.
So you're definitely going to have some unique perspectives about this space. You sell these entire portfolios, subdivisions, and or scattered projects, I should say, single family rental scattered
site portfolios.
Right. Yeah, so that's going to be very interesting, because I guess there's a really big market for this particular product, right? So hundreds of houses to be sold to one specific investor or institution or REIT or whatever it is.
There's millions of them, actually. And if you look at the entire realm of who owns single family rentals, traditionally it's been a mom and pop game, and it still mostly is. I think institutions collectively only own about 2% of the entire stock of for rent housing in the United States. The rest are owned, like if you think about it like a pyramid, institutional owners own like the least amount. And then you have people that own like 2 to 5, 5 to 20, 20 to 100, 100 and up. And like the biggest owner of single family rental properties is still the person that owns one, the individual landlord. And we just happen to focus on the top end of that pyramid, helping people that own, 10, 20, 30, 100, 500 homes sell to the biggest players.
Andy, introduce yourself, my friend. Tell us a little bit about how you got into build to rent.
Yeah, so I actually, so I've been in this game probably about 20 years, multifamily development, live work. But we started in the built to rent probably about 2019, 2018. We started kind of looking at it. I actually met Adam after hearing him on a couple of podcasts, and he really kind of informed a lot of our trajectory, honestly, based on the idea that, hey, look, you could compete with all these big boys, in a lot of the markets, 12 markets across the country, markets like, where Joel is, and, Austin, where they've got stuff, or Phoenix, where you are, Ruben, or we could kind of maybe build it in these secondary, tertiary markets, and then eventually, with less competition, increase the rent growth. There's a lot of markets out there, right? I think even Adam's talked about. So what I think what he just hit on, which I thought was so powerful, is where are we in this trend, right? So he's been in this 10 years, and then kind of really specifically with these buyers in that kind of 3 to 5 year range, only, the Invitation Homes, Homes for Rent, basically now you got Lennar building, there's a ton of them, but they only have 2% of the market. The multifamily market, it's probably closer to 55% control on Wall Street. So you can imagine us in the early innings with this kind of, wouldn't say necessarily the wild, wild west, but as Adam just hit, there's so many pieces of this puzzle to put together, right? So, we could essentially find the raw land, then sell it to another broker, right? Or sell it to another developer who's basically going to break it, create entitlements, et cetera. And then they're going to sell it to another developer that's basically going to go through all the infrastructure, and then to the builder, the developer that's going vertical. So there's all these kind of pieces. And what he was able to do, which I thought was so impressive, is in a very kind of off-market world, pull all these pieces together, which doesn't really exist, even when Invitation Homes and some of those guys took over, Blackstone, et cetera. They were just buying these scatter sites, right? So you have communities of, 100, 200, 300 units in basically a county they'd have to manage. And then some, genius, which seems like it's, of course, it should have happened, said, we'll build these all next to each other. And so that's kind of when the light bulb went off for me, which was, hey, we can manage these just like we are the multifamily, but we can give now people the big backyards and the dog parks and all of this kind of amenities that the multifamily has, but this kind of suburbanization idea that's been exploding even before COVID. So that's kind of when Adam and I started talking about it, and he's been one of the kind of leading voices in the space. And that's why I wanted to bring him on to this group, and just have him kind of break down. He's got a lot of thoughts on that.
I appreciate it, Andy. Yeah, it's always good to see you there. It's good to see old faces.
Andy, I'm gonna ask you to be a co-host on this particular webinar with Adam, so that you can ask questions. As free as I can, right? Because I'm running it at the same time. I'm very curious about this business model, this build to rent space. We currently, with Legacy Acquisitions, are in the process of potentially building up to 675 houses this year, which is insane, because if you had asked me if I was going to be a developer in real estate a couple years ago, I probably wouldn't have any idea that I would end up in this space. I kind of stumbled upon it by partnering with you. But why don't you ask Adam your most interesting question that I think you may have for him in regards to build to rent and why it's an exploding trend?
Well, first off, I think, let's just, I imagine this group, it looks like a pretty experienced group, but
we got some family offices in here.
Yeah, we've got a really experienced group. So I imagine they want to go a little bit more granular, but I am curious to hear kind of your opinion. So there's kind of the consensus opinion of why built to rent is becoming a trend, right? We've got, suburbanization, we've got, supply, issues. So of course people want more space, but what's your take on why this has become such a thing? I mean, because it was going on before COVID, talk about where you think the American dream, whatever it is, why has this become such a favored, son in the Wall Street world?
So it's a good question. I guess I'll go back to the very beginning. Like, if you look at build for rent, where it started as kind of a trade. There's a housing meltdown, and homes were at all-time low prices, and there was an artificial reason for that. And like before then, people like buying houses generally because the housing market has appreciated every year pretty steadily since the beginning of, like, when they started recording. and people need housing, and people need good quality housing. And when they can't afford to buy good quality housing, they tend to rent it. So as an asset class, it's seen, I think even before it got institutionalized, as a relatively safe, and not only safe, but like understandable thing. It's something you could feel, touch. It's relatively easy to reason out why it's a good long-term investment. And you get all the things you get with real estate, like, leverage appreciation. You get to build your equity, you get cash flow. So like it's an asset class that's been really highly sought after even before institutions got involved. And institutions got involved because it was seen as a good opportunistic play that turned into a operationally minded long-term business play. And the reason why no one did it before is because there was no entry point, which the downturn created. And it wasn't probably done before then, simply because it's a really, really big pain in the ass to manage a lot of properties over a very large period, over a very large distance. And it wasn't until like the opportunity was just so apparent via the housing correction in 2008, where like institutional investors actually decided to get involved and figure it out. And now that we're like 12 plus years after that initial trend took place, it's by and large been figured out to the extent where institutional investors from smaller size to medium size to the largest players now have technology to support marketing rentals, seeing rentals without even going into the property or having an agent show the property. It could all be done via the internet now. Being able to operate portfolios, scatter site over big distances through online operational platforms like Yardi and Appfolio. Like there's a lot of technology that was built over the last 12 years to help institutional investors manage this asset class, which started as buying one property at a time in markets where they thought they wanted to own real estate. And from a high level, it's a really simple, it's really simple to understand why they bought real estate where they did. And it kind of gives you kind of a playbook, or I shouldn't say a playbook, it gives you some kind of indication about where they'll probably grow to in the future. So like they started buying real estate in the places where it was the most distressed, places like Las Vegas and Phoenix. And those markets had the biggest bounce from the lowest trough to the highest bounce in terms of home price appreciation. And then it expanded out to markets like Charlotte, Orlando, Jacksonville, Tampa, Houston, San Antonio, every market where the fundamentals were there. Population was heading in the right direction. Economic trends were heading in the right direction. There were good, solid fundamental reasons why they felt people are moving there and will continue to move there. And generally over the last 10 years is where you've seen the biggest growth in institutional ownership of SFR portfolios. Those core markets all around the country. There's probably 30 to 40 of them. And now, we're at later stages where, and when you think about the build for rent trend and how it grew out of the single family scatter site acquisition of properties that were mainly foreclosures, the reason why build for rent became a thing is because in a lot of markets around the country, home price appreciation took off to the point where it was actually cheaper to build a new house than it was to buy an existing house. So you saw build for rent take places, funnily enough, in some of the very first markets that the foreclosure boom hit the hardest. So Phoenix was one of the first places you saw build for rent projects coming out.
Yeah.
Vegas was some of the first, and it expanded. And there's a whole host of reasons why build for rent is really exciting, and it's like the hot topic right now. But like looking back, you got to kind of understand what the genesis of this thing was. And I think it starts with fundamentals, but it also starts from the perspective of capital needs somewhere to flow that's safe and predictable. And single family rentals just tended to be that spot for a lot of institutional investors.
So Adam, you've acquired the skill of being able to sell these entire portfolios and or build to rent subdivisions off to people. We'll talk about that in just a second. I want to read a quote here from Warren Buffett. Back in 2012, he said, if I had a way of buying a couple 100,000 single family homes, couple 100,000, that's ridiculous. If I had a way of buying a couple 100,000 single family homes and managing them, I would. Back in those days, they had these things called bulk REOs where they would sell huge portfolios of houses. I'm curious, Anna, and I want to ask you this, like in terms of syndicating real estate, you have chosen to do this build to rent model. Why would you want to do this versus some other commercial real estate asset classes?
Why would I want to, or why would anyone want to?
I'm curious about Andy specifically.
Oh, God.
Okay.
Yeah. So I still like multifamily, believe me. There's no, we still were involved in a couple of deals with some people on this call this last year. So this isn't a knock on multifamily, but when you kind of consider what's happening with interest rates now, right? You're in that kind of 5.25, 5.50 range. And a lot of these properties in these larger markets at 3.5 caps or whatever. So that's what we call, right, negative leverage. Now there's ways to, increase rents, and certainly you're in markets with growth. And so there's still some demand for those types of properties. But on the built to rent side, we felt like if we can get in areas in the Southeast, what Adam calls, the smile states, we can get in areas where the Southeast, where the land is inexpensive enough, and we can work with mayors who actually like what we're doing, right? Because a lot of them don't want more apartment communities, it's traffic studies, environmental, and all the rest of it. We can come in and build these kind of enclosed communities where they really love that, and bring some beauty to the community. They really kind of like. So if we can get in those kinds of markets where they actually want us to build, and we can build it expensive enough, impact fees are lower, et cetera, et cetera. And I'm in California, so you could take you 3 years to do a project like what we're doing in the Southeast, right? We can build 10 a month. We can get through infrastructure in 4 to 6 months. So there's still challenges. Obviously, interest rates, if they creep up too high, that might be a problem for us. Arbor's our lender on a couple of our projects now. And supply chain issues, right? We got to have a large contingency on what we're doing. But this is new product, right? It's brand new. So the expense ratios that we would have compared to a 70s or 80s or even 90s property at maybe 50%, we can be in that kind of mid 30 range for the expense ratio. We don't have to have as much on the kind of make readies, et cetera. The tenants, or residents as we call them, are stickier. They stay longer, right? Because they got their backyards. They've got, they don't have people right next door. So there's a lot of those reasons. So it's not a knock on any other asset class. I think that there's some maybe there's some diversification on that one could invest in both. But I think is built to rent here to stay? And are we just at the beginning? I mean, Adam and I have talked about even like we haven't even talked about like nuanced communities. Like, what if you could build communities around health and fitness, right? Where you've got, basically a community of people that want to live in this place. It's got this incredible gym or wellness treatment, all that stuff, or, dog parks. I mean, maybe you could talk a little bit about that, Adam, where you could kind of see it going. I know why we kind of love it now, but we haven't even scratched the surface, really, when you think about all the dollars that are going to be pouring into this space, billions.
I got to ask, I mean, either of you two can answer this. From a profitability standpoint, is built to rent more lucrative than some of the other commercial real estate asset classes?
Well, yeah, but also there's more risk, right? So, one would say the risk reward, you gotta account for the fact that you're having to take raw land, turning in, get it all entitled, get the infrastructure done, build vertical with, supply chain issues and costs of lumber going up and down. So there's a lot more risk. Obviously, the back end, there's a lot. What would you say about that, Adam?
And you said a good word before, Andy. I'll kind of combine it with Ruben's question. You said the word sticky, like tenants are more sticky. And you asked where I think this thing is going. And I think a lot of people think it's like either multifamily or built for rent, because they're similar in a lot of ways, right? But I wouldn't be surprised if over the next number of years, you see more and more multifamily developers getting into the space, particularly because they want to own the entire life cycle of tenant, going from someone that might live in a big apartment complex in a 1-bedroom, 1-bathroom as a single person, to moving into a larger apartment, maybe when they get a girlfriend or a fiance, to moving into a rental house because now they have kids and a dog. And I think what you're going to see in the built for rent space is a number of different options for tenants to become owners over the long term, because it just makes so much sense. I mean, it's part of the media drumbeat right now against the single family rental space is it competes with home ownership, and they're buying a very small supply of existing single family homes and even new construction. And it's kind of a thing that the industry is fighting back against, saying, hey, we're creating much needed housing supply for those who can't afford to buy and decide to rent. And you think about like the arc of someone's growth from being single all the way through being married or even being an empty nester, the single family rental option is a really good one. And now that there's an industry that is basically entirely designed to create product for, and of course it starts out with the widest swath of people and their needs, meaning people that are like newly married people with one kid that they want to grow and they don't want to be, tied down to one house and want to grow along and have their housing grow along with their family. Like rentals are a good way to allow people to have that kind of option. And when the time comes, hopefully what I like to see is that nuance that you're talking about, Andy, where you have the option of going into, an active community for, working professionals, or a live well community for young families, or a, civic minded, whatever it is. It'd be really cool to see those nuances. And I think in the context of firms that have a holistic view of wanting to own the tenant experience all the way through to the end, where they either leave to buy a house or even buy the house that they're living in because the firm that created that rental opportunity saw that and delivered on that need. So it's a little sense of what I think it's going.
This is something that I've been reading about, kind of this, and it's usually Twitter, right? Twitter's always got the raging kind of opinions, but about, the Blackstones of the world actually kind of taking the opportunity away from people that want to buy a house. And I think we have to almost reset the way that we've been thinking about buying a home, right? Especially for millennials. The young, we try to find projects that are in kind of the schools that are elementary schools that are 8 or above. But those people care less about the kind of American dream of owning a home. If you kind of think about it in the context, I could pay my mortgage and then also have taxes to pay on top of that, do my own upkeep. Don't have the tech that Jeff Hawk could put in my home, these brand new homes that I could be living in a brand new build with a big backyard and amenity community that I could never buy myself. And this is a big point, I think now, there's no longer a stigma for me as a renter. Like I don't, or less of a stigma, I should say.
Yeah.
I'm basically renting in a community of new stuff with other capable professionals that may or may not have even been priced out of buying a home, but choose to live this way. So I think that there is kind of, I wouldn't say a sea change, but you are seeing an evolution in the way people think about what Blackstone and the rest of them are creating. I think we had a question about who are some of the big players. I think that was,
and I'll answer it. And it's not like I see the other side of the argument, because if you're like a young family trying to buy a single family home under $300,000 in like Charlotte, like you can't even go look at it because one of the big players will snap it up in the first hour of the first day it's online. So like there's definitely like there's credence to like the narrative that obviously the media exacerbates, where like these big bad companies are coming in and buying up all the housing stock. But I think like, people that want a government solution are looking at the wrong, like making rental restrictions a thing, which I think is a very bad idea. It's a bad way of going about it. The truth of the matter is there's a shortage of good land and lot developments, which creates a shortage of housing that builders can build. I don't think the solution for that is stopping the build for rent players. I don't think it's restricting the industry. I think they should help them, if anything. I think there should be government incentives for people to buy land and develop land in areas that need housing. There's a dire need for people with that skill set of buying land, entitling land, building lots for builders to build houses, and there's just not a lot. There's just not enough of them right now, and that's why there's a housing shortage versus the amount of people that actually want to buy and not rent. But it would help all. I think it would really help all.
So I'm very curious about this particular thing, because I think they hear build to rent and they know that it's very hot in Phoenix. What they may not know is what's the difference between investing in BTR or developing BTR in a big market like Phoenix, Dallas, Atlanta, versus some of the place that we really like, which is in the Southeast in a secondary market. Why can you do one business model with institutions in Phoenix, but it may not make sense to do it that way, and instead you syndicate it and raise capital from limited partners in a market like Louisiana?
So yeah, good question. Build for rent is a big thing in any of like the top, call it, 30 to 40 markets around the United States, like 30 markets around the United States. It's a big thing. They're trying to build these communities everywhere. And everyone that has these land, it's funny, I get sent quote unquote build for rent opportunities all the time, but they're really just like land in all these various markets. And they're not built for rent, they're just land. And they could be built for rent, but they're not yet. So how you got to think about it is institutional investors and fund investors, or even people that are like private equity players that may invest their own money or invest money for limited partners. They want to put the money somewhere that it's protected and has, there's some safety or implied safety. They want opportunity for steadiness, steady cash flow and growth, both rent growth and appreciation growth. And when you start thinking about like tertiary markets, like places like Louisiana, certain places anywhere throughout the country, like name the 1,000 tertiary markets you possibly could build for rent. And why isn't it happening there yet? Because the capital wants to flee to the place where it's the safest and the most desirable in terms of growth opportunities. And that comes in markets where you generally have the highest populations, you generally have positive economic trending. And I'll give you an example. Like you want those drivers. And when you have those drivers, it's really easy to convince an investor to place money there. And it's all about finding the right land position so that you can say, I'm going to build enough houses to have an on-site management company. So it looks and feels like multifamily and there's an operational ease to it. Or if it's not big enough to have an on-site leasing office, it's generally going to be bought by a firm that wants to create scale in that market where they could put their own property manager and manage that community in addition to other communities they might buy around. So the focus is in places like Phoenix and Vegas and Orlando and every major city around the United States. That's where the focus is right now, because there's lots and lots of land out there. And before they start looking at these more tertiary markets, they're looking in these places they consider more desirable and safer.
The red tape in Phoenix is significantly different. Go ahead, Andy.
No, the one thing I wanted to add too is what he's saying, which may seem obvious, but to some it's probably not, is that the vice president, most of the money that's coming into built to rent is coming through funds, right? $1 billion. They'll let little guys, developers do all the heavy lifting, and then they'll come in and they're pushing their yield, right? They need, CalSTRS and CalPERS and all the rest of it. So a VP who decides that he's going to step out of the box, it's kind of like those coaches or those GMs in sports, right? If they decide that they're going to take a chance on somebody, they know that they're risking their job. But if they're wrong about Phoenix or Austin, all the rest of it, everybody else is wrong too, right?
Yeah.
So I think what we've talked about with Adam is the way we can get secondary, and this might be helpful for people on the call or people that are listening, is the way that you can build some credibility in that area is by doing it, right? And so you do have maybe a lower resistance from one, competition, to kind of oversight of the municipalities, neighborhood council, all these kinds of potential roadblocks that if you can get to 300, 400 units in an area, prove out the model, prove out the growth, prove out the income.
It doesn't even have to be that big, Andy. Like it doesn't have to be 400. It could be 30. It could be 30. You stabilize it and prove there is a need for that kind of housing, and you can show year-over-year rent growth.
That's what I was going to say. I don't think they want to take the upfront risk on an area that they're not as sure on, but if you have a good, solid product, it's fully stabilized or on the way to that, they'll come looking for it eventually too.
Yeah. I agree. By the way, we should open this up to questions. I don't know how long we've got with Adam.
5 more minutes and then we'll open it up to questions. Okay. I do have to ask about the red tape. Why is it harder or more challenging to develop? And why do we select particular markets where you can develop much quicker? Is it because the land is much cheaper in Louisiana and Alabama and some of these Southeast markets? Is it because they actually can help you with the city engineering and move you along the entitlement process much quicker in these markets? Why is it so challenging from the time that you buy a piece of land in Phoenix to the time that you can actually develop on that land? Why is there such a stagnant difference between Phoenix and the Southeast in terms of the timelines? Because as capital raisers and as syndicators, one of our major jobs is to get the investors' money back as fast as possible. And in Phoenix, where institutions are investing in these build to rent projects, they can hold and wait, and they don't care about it as much as, you know, as a limited partner in a deal that wants their money back quickly.
Yeah. Is that for me?
Whoever.
Yeah.
Go ahead,
I mean,
Adam.
I could chime in. I don't think it's only in Phoenix. In fact, I know it's not only in Phoenix. I think if a lot of people are listening to for syndicators, build for rent's really exciting because you can go anywhere and you can buy a piece of land. And if you get it zoned correctly and you create a attractive enough site plan that would be conducive to a built for rent, you can exit after site plan approval if you could find a buyer to buy that land. And that's an exit point. And then you can build the lots and then either sell to a built for rent fund or a builder to build retail housing, and that's an exit point. Or you can build the homes and you can sell it to a built for rent fund, or you can sell retail. So like, I think the reason why big institutions buy in certain markets because they got drawn there and that's where they built their infrastructure. So like if you're an investor and you know Wichita, Kansas really, really well, or like one of my clients sees in Northeast Arkansas, Northeast Arkansas, like he owned lots and lots of land positions that he planned on building retail homes with. And then he just realized he can build homes on it because he was doing that during the downturn, and all these houses he couldn't sell, so he put tenants in them. All of a sudden, he's the biggest owner of rental housing in Northeast Arkansas. And now he's got a 3 or 4 year operation history. And I can't tell you how many institutional investors are begging him to buy his portfolio to come to that area of the country. Never would have happened if he didn't start off by buying land to build retail housing on. Never would happen if he didn't, couldn't sell those houses for the right price and put tenants in there. But since he did, as I suspect a lot of your listeners could, you can start off by doing this business in the place that you know best. And as long as you can kind of keep hold of your real estate and prove there's a real need for that kind of housing, that's how you're going to draw the big money into your marketplace. And I don't think it's until a player like that is in a market are you ever going to get real attention put to it.
Your comments, Andy, before we
no, I was just actually thinking as Adam was saying that, like, because Adam, he runs a brokerage, so he could basically makes money on the raw land, right? And he sells it down the stream or up the stream, I guess you should say, to entitled land. And then you make another fee, right, Adam? And then you can make another fee once you get the infrastructure in, and then you could probably build out 10-20% of the actual units and sell them to another institution. So we're in the wrong business, I guess, is what I was just getting at.
And you could do it as a principal too. I look at it from the prism of a broker because that's my strategy. You could look at it from the perspective of if you're someone that knows how to buy land and develop it, and you can bring in, like, let's say you didn't know how to develop. Let's say you were just a real estate investor that knew how to bring it through the entitlement process. You can go and bring in a horizontal contractor and say, hey, I want to be your partner, and I want us to develop this land for a built for rent project. So let's create a partnership where we share that fee, and I'll bring the land, you build the lots, and we'll share in the profit that we create by adding value. And you could do the same with a local home builder. Let's create a partnership where, like, you come in and you do your piece and we both take the ride all the way through the end products. And then you might even be able to find an investor to say, hey, we don't want to sell you our built for rent. We want to be a partner, and we want to take the ride all the way through your exit in 7 years. So, like, there's tons of ways to skin the cat. That's what makes it so exciting, because if you know a lot, even if you don't know a lot, but you know more than other people, there seems to be a ton of opportunity because it's everywhere. There's opportunity to build everywhere.
Yeah. In development, there's a lot of opportunities for forcing appreciation. So what you mentioned, right? You can take the land, you can entitle it, you can start building on it, you can sell it off at any given point, you can take it all the way to completion, and then you can sell them off as individual units, as houses, or in groups of 10, or in groups, like entire subdivisions at one time. So there's multiple ways to exit, which is one of the great things about development Andy, you got something to say?
No, I just wanted to ask Adam, so in some of the deals that you're working on, what would you say, is there kind of a general, and it may be way too hard to kind of give me a generalization, but from taking raw land to entitled land, or from taking entitled land to basically shovel ready through infrastructure and all the rest of it, is there any kind of premium that you would basically generalize with each of those stages? Like, what would you, as a broker, you've got to basically market that. Is that against comps, or are you kind of adding a certain layer of value to each stage arbitrarily? How are you valuing those stages?
Yeah, so it's funny. I do this almost, or my analyst does it every day. I always start from looking at current retail comps and figuring out what like today's retail value is, and then figuring out like how long the project will take to come to fruition, and then estimating what type of appreciation rate would bring me to an all over like retail price when the project is actually done. So like that's like the high water mark. If you can figure that out, you can back into the rest of the numbers, because the next step is to figure out what the rents are today, and then figure out what the rents might be when it's actually finished. And when you do that, you can take that retail price and that kind of retail rent assumption, and you can break it down into a cap rate. And I know this, not a lot of people do know this. So I see a lot of buyers. So I know what cap rates buyers generally need to buy into a project at in order for the numbers to work. Like if you're selling something stabilized, you're looking to sell it at a 3.5% to 4% cap rate right now, right? Maybe even less, depending on the market. If you're buying finished units where you're taking up lease up risk, but because they're vacant, you're going to need a 4.5 to or a 4 to a 4.75% cap rate. If you're selling lots, you need a little bit higher cap rate. If you're selling land, you need a little higher cap rate, right? So if you can start off from the perspective of knowing what the retail market is doing, generally you don't want to price any higher than retail, because then you look greedy, and then you look like you're unreasonable. You don't want to look like that. You want to look like your assumptions are based in reality, and you're taking into account current retail pricing, current rent pricing, and appreciation and rent growth.
Well, wait a second here, because I'm curious about this. If you sell the entire subdivision off as one commercial property, it's based off of the net operating income. Is the subdivision worth more if you sell them off as retail houses, or is it worth more if you sell it off as one commercial asset?
I don't know that it's a big conversation in the SFR space, the built for rent space. Is it based on NOI, and is the pricing based on cap rate, or is it based on retail values? I tend to go the safe route, which is saying I'm not going to build to a cap rate and just totally disregard what retail values are doing, because generally real estate pricing is based upon comparable sales. It's the way any realtor does your pricing ABM. It's the way any online ABM any online ABM prices your real estate. It looks at what the home sold for next door that's like your home, and it prices at that level. If you do that and you compare it to like an NOI analysis, I think you'd be hard pressed to find any buyer that's not going to look at retail values and say, why would I buy this at a 3.5 cap, which is like 20% over retail values, versus just going and building them myself or buying retail housing. And what sellers might say is, you can't get my community unless you pay my pricing. And those
you can't get my stream of income that I've
my project,
out of you could go ahead and do it yourself, and then you created the value yourself. And that's why I think it's so interesting. And like, you got a 100-unit project that we're working on now, and now we're developing a 200-unit project. So you got that income part, and then in some markets, because prices have gone out of control just on the actual home market. So that's part of the reason Wall Street loves it, right? They've got the yield on the rents, and then they've got the prices as the market is soaring. And so you're trying to kind of put all these pieces together. But I would argue that if you're doing a 100-unit project, and maybe you're chunking it down to 10, that multifamily buyer who basically typically buys its real estate on whatever that income stream is,
right,
that's more likely. But you're right, you're going to get some pushback if you start to go in 1s and 2s and 3s and 4s.
And there's a cost, and I'll add to this point. People are getting above retail value when selling their built for rent projects. they're getting some level above retail value or retail value. But that's also creating a comp for retail values, which kind of increases the price of housing in the area. I haven't done the study, but I'm sure if you do a study between what build for rent projects cost and how much the retail values of the homes are, my assumption is you're probably in a pretty close range. And if you're not in that pretty close range, it just means there's a massive lack of supply in that market of either multifamily or residential built for rent housing, which is why it's demanding that kind of premium.
Yeah. Let's open. I mean, we could talk all day with Adam about this. We may have to have him back to finish, but
that was the point.
I wanted to basically open it. Certainly, just open it up to anybody has.
There's a few questions in the chat.
Okay.
It looks like there's even new ones coming in. I'll start with this one. So, did we name the top 5 companies, hedge funds doing business in this model now? I think that was one of the questions.
I mean, you can look it up on Google, top single family rental investment firms. Like, I'm not going to give you a ton of names because a lot of these names people don't know, and I'm a broker and I keep pulling that information pretty tightly. But like, Progress Residential, Tricon American Homes for Rent, Invitation Homes, Tiber Capital. There's probably another 7 or 8 I'm not naming that are the top ones, most of which are public REITs right now. If you go online and search top publicly traded single family rental REITs, it'll pop up like almost right away.
And what I think is fascinating about that is you've named all these largest, how many houses do they own? Like what is American Homes for Rent? How many do they own at this point? It's not that many.
Several tens of thousands.
Yeah. So like 70,000. I think it's 70,000 is the largest, something like that. When you think of that in that perspective, it's not very many homes that are out there that are being controlled by these guys.
It's not at all. Invitation Homes, I don't know if it's in the hundreds of thousands, but like collectively the top 10, I don't know the number. I won't give you wrong information.
I have it. I think it's 130 is the most. And I think,
but don't forget, people tend to discount. And when they come to me to sell their portfolio, the build for rent project, they're like, yeah, I know Progress, I know Invitation Homes, I know Tricon. I'm like, yeah, but you don't know like the 30 other firms that raise capital that might want to buy your projects at a better price because it more closely fits their footprint and their overall long-term objective than trying to squeeze it into the institutional, mold. So like when it comes to knowing the landscape, there are hundreds of funds that are actively buying scatter site and building their portfolios through either, individual purchases or built for rent acquisitions. And I always look toward the firms that have the footprint in the area and the cost of capital that's going to allow them to be the best buyer. And that's how we run our dispositions, by picking those firms because we know through surveying who they are, and they give us that information because they want inventory from us. I don't necessarily just go to like Invitation Homes or Progress or any of the big firms, generally because they have the tightest buy box. They actually need to buy more specific properties down to the zip code, as opposed to a firm that's actively really trying to catch up to those guys that'll buy based upon, a larger geographic area.
That's good. What were some of the other ones, Ruben?
So let's see if I can verbalize this. Question from Richard Hall. Would structuring renters with the right of purchase at some future time or applying a portion of rent towards future down payment help potentially overcome cities' regulation or restrictions and build a more resident stickiness?
You want to take that one? You want to talk about it?
Yeah. Richard, did you want to elaborate? I think I probably need a little color on that. Go ahead.
I think I understand what you're saying. I think that is a nuanced strategy that people have been doing forever. I mean, people have been doing rent to own for a long time. And I think that industry segment is generally seen as a little bit dirty, I think, by a lot of people, because a lot of people are less than, I shouldn't say this. I shouldn't say a lot of people, but some people give that industry segment a bad name. They charge high fees to get into the program, and they don't qualify the buyer. And a lot of those people that enter those firms have no chance of actually owning the home at the end. But if you're an honest purveyor of that business strategy, I think there's a lot of merit to it. I don't know if using that strategy as a way to circumvent like rental restriction laws is necessarily going to be successful, because I just don't know where that takes you at the end of the process, whether or not they'll become savvy to it and create another restriction. But as a general business practice, I think renting to owning is a workable strategy. It's hard to scale. And as far as institutional buyers right now, I haven't seen any trades happen in the industry where a big portfolio of rentals with notes on the properties and contracts on the properties for the renters to buy them. I haven't seen a big trade happen in that respect. So God knows if you did build that business and it became really large, what the opportunity would be to exit that to a larger capital investor. It just hasn't happened yet. So
all right, so some of these questions are a little wordy, so I'll invite the guests of the call to to take themselves off mute and then ask Andy or Adam directly your questions.
Well, Paul had a good one.
Yeah.
Paul, are you available?
Yes, sir.
All right. Yeah, good. So kind of for the rest of the audience, if you wouldn't mind just kind of asking your questions, see if Adam can break it down.
So Adam, if I had, let's just say 10 acres of ground and I built 20 doors on the ground, 20 houses on the ground, 1,300 square feet, and let's say my ground and build cost was $200,000 a door, and I was able to get rents of $2,300 a door from a cap rate, or to sell to a bigger organization, would I be able to sell those at $350 a door?
Absolutely. Yeah. Let me do the math on that real quick.
Run it at $400,000 a door. Would I be able to sell it at $400,000 a door?
I'll just run it out of cap rate. So you're saying it's $2,400 a month in rent?
2,300. Yeah, let's go with 2,400.
$2,400 a month in rent times 12. 2,400 times 12 months is 28,800. Let's assume there's like a 35% expense load on it, so the NOI is about 65%. So 18,720 is your NOI. And let's say you can sell that like at finished products, like vacant. You're saying?
No, occupied.
Occupied. So let's say you sell it at a 4% cap rate. 468 is what you should be able to get from an investor that's willing to buy it at a 4% cap rate once, because it's stabilized.
If I had 20 doors spread over 100 locations, let's just say in a state, whether it was Florida, Missouri, Texas, let's just say Missouri. If I had 100 sites with 20 doors on them, and so I got 2,000 doors, I would still get the 450,000 a door, basically.
I'll give you a caveat to that number I gave. So let's say retail comps currently are at like 400 for that property. You might have an issue getting to 468, because don't forget, these people that are buying it need to finance it, and they're going to be taking into account retail valuations. So I think you'll end up getting offers, and you might, if the location of that single site is attractive enough, you might actually get some margin over retail because the cap rate is so good. I don't think you'd be able to get the same cap rate for a scatter site, just because they're harder to manage. They're more sensitive to retail values, because you're less likely to get a buyer that's willing to just bet entirely on the cash flow. I tend to look at scatter site portfolios as trading at and I don't know this for a fact, so I probably shouldn't say it, but I would assume you need a slightly higher cap rate in a scatter site portfolio, because it's more sensitive to retail values than the single site is. I think it's because the way that buyers are going to be looking at a single site more like a multifamily, and are looking at scatter site more like individual houses spread over a large area. So my intuition is to say, you're going to get a lower cap rate on the single site than the scatter site.
Who would I go to find somebody that would joint venture with me that would have the money to do this? I know the sites. I know what to build. This is a $500 million play. I've already done it. I just need somebody to come in and help me buy the ground at these sites. The business model really is, it's actually a little bit cheaper than that. I figured the positive cash flow on these doors, if I put it towards my construction, my loan, I can have these paid off in about 12 years. The game plan would be to hang on to these for 12 years, then sell it off to the REIT when it's fully paid off. and 2,000 doors comes out to about $500 million.
Yeah. It's a huge amount of housing. I always, when I look for places to go fishing, I always look for like the organizations that capital sources go to meet owners and operators and other capital sources. IMN, Information Management Network, throws a single family conference twice a year. They have a couple of built for rent conferences. If you look at that website and look at all the attendees, you'll see a bunch of capital companies, and you just got to do some research to find out which ones might want to co-GP. It's a lot of work, but like once you kind of get in the industry, you kind of know who is who. So like that's one. National Rental Home Council has a high level symposium that they do, I think twice a year. If you go to that website, you find out who the members are. You find a lot of capital companies looking for operators. It's another good way. Looking in the place where you live to find out if anyone's done any big built for rent or big or even medium-sized SFR portfolio acquisitions. Very often those are operating companies that are partnered with capital companies. And you can just do some research. Usually there's a news article that comes out when an operator raises capital from a capital source. You might call up the capital source and say, hey, I'm an operator. Do you have a division that kind of vets operators to partner with?
Where are you, Paul? What state?
I grew up in St. Louis, Missouri. I was a fireman for 17 years, did real estate on my day off, met a gal, fell in love. I live in Sacramento, California, specifically a suburb called Roseville, nice area. There's 2 organizations coming out here. One's building, I believe, 200 houses, all build to rent. And there's another organization building like 90 out here.
If you're, are you a land developer, Paul?
I had teamed up with the builder back in St. Louis in the day, and we had built out 7 subdivisions. I was the one that raised the capital. And so I'm not really a land developer, no.
Okay.
But the business model that I've got, I cannot shoot a hole in it. I won't say it right here, but my business model that I've got, any one of you on here that would look at it, in about 5 minutes, you'd go, that's freaking brilliant, dude.
I know a good broker that you could talk to.
I would love to. Is it you?
Yeah, it's me.
Yeah, can you shout out your number real quick?
Yeah, sure.
We'll Adam, you should get your info because I know you also have the new site that you created.
My email, sorry, I'm not gonna miss an opportunity. And it's astern@stratasfr.com. astern@stratasfr.com. STRATASFR. And you can just go to stratasfr.com and hook me up too.
What's your phone number?
914-906-5847.
And put that in the chat too, Adam, if you would. And sure. And Paul, we'll put some. I got a partner up in Northern California that actually helped us with some built to rent in the Southeast, but he's in Sacramento as well.
Andy, what's your number, Andy?
Yeah, 310. I'll put it in the chat too. 310-920-2441. And any of you feel free to text me as well. Andy at Legacy Acquisitions. I'll put it in the chat. But yeah, I think you're in the right community, Paul. I think we should be able to, as a group, be able to help you get what you need.
Well, in this, I'll tell you that this business model is all based around senior living.
Yeah, interesting space. Very particular buyer that you're an exit to. It's not like a core strategy of a lot of professional SFR companies, although I think it will be eventually. But it's a nuanced product. It's probably the top nuanced products that institutional investors are looking for. Just to get it, you got a tighter market though.
Good. Any other questions? Ruben, I don't know how long can we go?
Yeah. So we're coming up at the end, but I'll allow for one more question if anybody's got it. Go ahead, Jeff.
Andy, when you look at this type of housing product, are you looking to do it as traditional stick built, or you're entertaining using modular to deliver the product? Because I do have some other client, or connections. I actually interviewed a guy on my podcast from a group called Casada. They're building communities like this, and they're going modular. They also have leaned heavily into like the community curation, the activities. They have a whole strategy around it. But I'm kind of curious, like, is that a vehicle to, in a sense, reduce some of the risk by, using a more set building standard? You could do your site work, in advance, do modular, and then kind of roll faster on the stand up of the units.
Yeah, I'm really glad you asked this because I think this is one of those things that's like rolling really fast, right? And I think it all kind of hit when supply chain issues were out of whack and people are talking about how long is it going to take us to build. So our projects so far have been stick builds, but I will say we've been talking to a lot of people. I'd love to hear Adam. Just I'm not quite sure if the lending is quite there yet. There are some because it's a newer thing, but it's becoming a lot more I was talking to a developer who basically he was doing stick build and he was actually doing some in Florida. He had kind of it's a different build and more concrete, but he was basically doing all modular now and at large scale. So I don't know what if you're hearing anything, Adam, if there's a difference as far as the deals that are getting done, but I've seen really in the last 90 days, probably even 60 days, that there's been an acceleration in that space.
Yeah, like more modular construction, 3D printing even. I think it's so new and people don't really understand it. But from what I've heard, the people that are planning on using or are using modular construction and 3D printing are the value it adds from a built for rent perspective is timing. You can develop land and start building lots and like start building your house in a factory before you even get the lot on the ground. And if you have like a warehouse space, you can start warehousing your product type before the lots are even on the ground. And if you take like a normal development timeline from like, finished lots or entitled land to getting the finished lots, it might take 6 months to 9 months to put a phase on the ground. And then you start building the house. It takes another 3 to 4 months to put the first 15 on the ground. And then 10 or 15 every month after. It's a big timeline. Like you start a project, it might take 18 to 36 months to finish it out or more. Or like if you have a single buyer waiting to buy the units as soon as they get done, because there's rental demand there, and you can cut that down by using modular or 3D printing. And you can prove that, I guess not prove, if you can create a contract with the buyer that protects them enough from all the unknowns, like I don't know enough about modular buildings to say what the unknowns are. But if you can speak to those pain points via your contract and shift the risk away from them so that they can get a project in a more condensed time frame, which means a cheaper project at the end, I think there's a lot of merit to using 3D printing. And
what are the risks, Jeff? So give me an example. I'm always curious, why wouldn't this work? I mean, are lenders not quite there with it? Are insurance companies not quite there with it? Like why wouldn't we want to be doing modular housing at this point?
I mean, I think the 3D printing, Adam, you're right on that. That's still coming up. I have a friend that's actually doing a house on Long Island with it. The scale's not there on that methodology. The product is nice, but the scale's not there. As far as the modular, I think it's proven. I think it can work at scale. I think there's a lot of greatness there because you do the site work first, you get everything ready to go. You're building your houses in a factory. And I mean, a guy that I know, he turned around 65 houses in like 18 months.
Yeah.
I'm a huge proponent of it. I have to introduce you, Andy, to these guys.
Right.
They did the first project in Austin and they have 5 more coming up in Texas. So they're leaning heavily into it. And I think it's a great way to go. And you're highly standardized on the caliber of the materials, the product, the delivery. It's a lot more you can control in that environment. So I'm a huge fan of it.
Awesome.
And the reason why people aren't doing it right now is because they just don't know the people that have it, right? People use the same subs project in and project out. And if your subs know how to do stick built housing, that's what you're going to do because it's the easiest thing to do because you know it. And if you introduce this new way of building, especially in a way that's lower cost or can be faster, people are going to use it. It's just a matter of getting people to understand it.
Yeah, and I think you hit it on the head. It's not even the cost necessarily, right? It's just the speed with which you can kind of control that element. If it's even a little bit more, but you know that consistently you can get these things up in 6 months or 9 months or whatever that is, as opposed to kind of building 10 a month, worrying about rain, all the rest of it.
Yeah,
that's just natural rot, right? That you would see in stick build that you're not going to see in modular housing. So yeah, there's a lot of benefits to it. I'm really curious where it goes. All right, Ruben, do we take us out or
let's take us home, guys? This has been awesome. Some really amazing conversation about numerous topics here, things that I didn't think that we'd actually cover. So this has been really cool. But with that, we're going to wrap up. Thank you, Adam Stern and Andy McMullen, for joining us and all of our guests and listeners on the podcast. With that, we're going to wrap it up. Enjoy your day. We'll talk to you next time.